the bank that built a nation and almost broke it. Cold Hook. March 30th, 1841. Athens, Greece. A single decision is made in a marble building that will echo across nearly 2 centuries. The National Bank of Greece opens its doors. For the next 170 years, this institution will control the financial lifeblood of an entire nation. It will survive Ottoman occupation, world wars, civil war, and dictatorship. And then, in 2010, it will nearly drag Greece into complete economic collapse. By 2015, Greek depositors will have withdrawn over €200 billion from their accounts in pure panic. The bank will survive. But the country almost won't. This is the story of how one institution became too big to fail, and what happened when it actually did. Greece declared independence from the Ottoman Empire in 1821. But independence without a financial system is just geography with a flag. The new nation was chaos, no currency stability, no credit system, no way to borrow, no way to invest. Enter the National Bank of Greece. Founded on March 30, 1841, it was created with a specific purpose, to be the sole institution that could issue currency in Greece. This wasn't just a bank. It was the financial backbone of a brand new country. For 80 years, this worked. The bank printed drachma, lent to the government, financed industry. By 1920, it was the largest bank in the Balkans. But here's the trap: when you become essential to your nation's survival, you become untouchable. Fast forward to 1981. Greece joined the European Economic Community. Then in 2002, Greece did something extraordinary: it abandoned the drachma and joined the Eurozone, adopting the euro as its currency. Here's what that meant: the National Bank of Greece could no longer print money. Its core power was gone. But its size remained. By 2008, the National Bank of Greece controlled approximately 25% of all banking assets in the country. It had over 600 branches. It employed 30,000 people. It was woven into the fabric of Greek life. Then the 2008 financial crisis hit. And the National Bank of Greece, like Greek banks everywhere, held massive amounts of government debt. Greek government debt. The same government that was about to admit it had been lying about its deficit numbers for years. In 2009, Prime Minister George Papandreou revealed the truth: Greece's budget deficit wasn't 3.7% like the previous government claimed. It was 12.7%. The country was insolvent. By May 2010, Greek 10-year bonds were yielding 12%. Banks couldn't borrow. The National Bank of Greece, which had survived 169 years of history, was staring at collapse. It was rescued by a €110 billion EU bailout. Then another. Then another. But here's what the headlines missed: the National Bank of Greece didn't fail because of bad luck or market forces. It failed because of a specific decision made in 2002. When Greece joined the euro, the European Central Bank required Greek banks to hold Greek government debt as collateral. This was the rule. It was designed to strengthen the eurozone. It did the opposite. The National Bank of Greece loaded up on Greek government bonds. So did every other Greek bank. They had no choice. The ECB's own rules made it the only safe investment. By 2010, Greek banks collectively held over €150 billion in Greek sovereign debt. When the government's credit rating collapsed, every bank holding that debt collapsed with it. No one had forced them to buy the bonds. But the system had made it the rational choice. The real scandal wasn't incompetence. It was architecture. The European Monetary Union created a condition where Greek banks became dependent on Greek government solvency, and the Greek government had become insolvent. The two were locked together. The National Bank of Greece didn't cause the crisis. But it became the instrument through which the crisis struck the Greek people. Here's what this teaches us: when a single institution becomes essential to a nation's survival, regulation doesn't save you. It just delays the failure and makes it bigger when it comes. The National Bank of Greece was too big to fail. And the moment the system decided that, it became too interconnected to survive. Today, the same logic applies to your bank, your pension fund, any financial institution deemed systemically important. The rules that supposedly protect us, capital requirements, stress tests, regulatory oversight, they don't prevent collapse. They just reshape it. The National Bank of Greece still exists. It's one of Greece's predominant banks. It survived the near death of 2015. But 180 years after its founding to save a nation, it became the instrument through which that nation nearly destroyed itself. That's not a banking failure. That's a design flaw. And it's still in place. This video is for educational purposes only. Not financial advice.